Chapter 14 is financial statement analysis. So let's jump right in. If you want to look at Johnson & Johnson, you want to understand them. You want to understand their financial statements and get as much out of them as you can. In 2023, they had net income of $14.8 billion. Is that good? That's a return of just less than 7.9%. And we want to know, is that what it's likely to be in the future? Is it the same amount? And so we're going to use financial statement analysis to answer questions like, okay, why is this different from year to year? Is this typical for a company of its type? What's the trend? What's the trend expected to be? So the goal of accounting information is to provide useful information to decision makers, and the financial statements are generated and designed to assist users to identify key relationships and key trends. We note that financial statements of most publicly owned companies are classified and presented in comparative form. And so we want to look at certain items in a group or in classification to assist us. And we note that classified financial statements, especially the balance sheet, separates assets and liabilities into current and non-current categories. So in a classified balance sheet, assets are usually presented in three groups: current assets, plant and equipment, other assets. As well, liabilities are classified into two groupings, two classifications: current and non-current or long-term liabilities. So if we're to look at a company here, in this case Computer City, we're going to note that on its asset side we have current assets, we have long-term assets, and then we have other assets that are included here. And that would be an example of a classified balance sheet. Now on the liabilities and owner's equity side, and I should say liabilities and stockholders' equity side, we note that there are current liabilities and there are long-term liabilities. And then we have stockholders' equity. And so this classification helps us determine when things come due and what cash flows are likely to be in the future. Financial statement analysis is the process of using analytical techniques to examine and compare financial statements and other relevant data to evaluate the past and predict the future. And so we're going to use that, and we're going to use an analytics lens to do this. First of all, we're going to define who are those users. So potential shareholders, current shareholders, creditors, those who have given us a loan or may receive a loan, suppliers, managers, employees. Employees determine if they want to pursue a career at this company. Even customers, if they buy something, they want to know, will it be around to service this? Will the warranty be any good? And what if I need replacement parts? And so these are examples of financial statement users. And to do so, we're going to go back to the AMPS model, where the AMPS model is ask the question, master the data, perform the analysis, and share the story. And so we're going to illustrate that here in terms of this diagram. You're going to see across the top is ask the question, master the data, perform the analysis, share the story. So we have a specific question. A specific question might be, what is the value of this stock? Or are cash flows expected to increase in the future? Or when this loan comes due, will they have enough resources, cash flows available to pay it off? Next, after we've asked the question, we want to know what data is available. So this is a financial statement analysis chapter. We're going to talk primarily about the financial statements. As part of those, financial statements are part of the filings with the Securities and Exchange Commission, but certainly press releases, conference calls, analyst reports, other companies' financial statements, MarketWatch, Yahoo Finance would all be sources of important data. Okay, so now we've asked the question, master the data. Now we want to both understand the past, and we're going to use descriptive and diagnostic analytics to do that. And you can see descriptive is counts, totals, sums, graphs, charts, minimums, maximums. and various types of simple analysis to tell us what happened. I often describe financial statements as descriptive analytics to tell us what happened. Why did it happen? Or, what occurred? Why did it occur? And so we're going to use common size financial statements, certain ratio analysis, certainly disaggregation, certainly those classified financial statements, and comparisons to benchmarks will help us do that. A lot of times in our questions, we are actually asking a question about the future. And we're trying to determine if what happened in the past is likely to happen in the future. And so we want to use some predictive analytics techniques to determine if the trend will continue. And then once we decide and predict or forecast what's going to happen, then we're going to decide what should we do. What sensitivity analysis are we going to use? What is going to be our discount rate? What happens if we use a different assumption, like instead of sales growth of 2%, it's 5%. And then finally, we're going to share the story and we're going to try to address the question that's been asked in a variety of forms that might be useful. So to start off, let's talk the different types of analysis. We've kind of done this, but descriptive analysis says what happened or what is happening, and the cash flows might be used to do this. So the question is, did the company's debt relative to its assets increase in the past year? Hey, that could be answered with descriptive analytics. Diagnostic analytics, what are the component parts of ROE? Why did it happen? We got a return on equity or a return on assets of a certain amount. Well, why? What were the causes of that? Predictive analytics might be used to forecast. What's the level of expected sales or expected earnings or cash flows? So those would be predictive analytics types of questions that need a forecast. And then what will be the company stock, the value of the company stock if the companies grow by 30% instead of the expected 15%? And so we're going to do some analysis to determine that. What are we going to use as data? Financial statements, footnotes to those financial statements would all offer important information. SEC's Edgar website might have easy access, at least for public corporations, to their financial statements and any other required disclosures. The company's investor website might have certain information that's needed. CalcBench and others would be used. So these filings might give us information about management discussion and analysis or executive compensation. There's going to be stock price data that might be useful, press releases, conference calls, and other information might come from a variety of sources. Once we have the data, we're going to start to perform the analysis. And we've talked about that in terms of understand the past, see if it is persistent into the future, see if they're related to each other, and then finally evaluate the options using descriptive, diagnostic, predictive, and prescriptive analytics. And so as examples of descriptive analytics, we're going to use counts, totals, sums, averages, mins, maxes, standard deviation, looking at things like volatility, how many loans were extended, how many customers did we serve, what countries do we have our products, and so forth. Other descriptive analytics, just showing it now graphically. What are the levels of quarterly profits over the past 3 years shown in a bar graph? Okay. And that might help us determine if there's a trend into the future. A percentage increase from past years. Okay. Is interest as a percent of sales increasing or decreasing over time? Calculation of important ratios. And oftentimes there's kind of a shaky line between descriptive and diagnostic. I mean, descriptive is really what happened, but then we quickly move into the why did it happen, but sometimes they're really related to each other. Okay, so diagnostic analytics allows us to compare performance to appropriate benchmarks. And so what is an appropriate benchmark? Is it other companies? Is it the industry? Is it the economy overall? Are all good questions. So component percentages of the balance sheet. We sometimes would call this a common size financial statements, where everything is expressed on the balance sheet as a percent of total assets. Or a common size income statement where everything is presented as a percent of sales. And that allows us to compare the amounts over time. For example, cost of goods sold went from 60% of the total to 70% of the total. And so, why did that happen? That's a good question. Are we selling more expensive products? Are the component costs going up as a percentage of sales? Why is that? So what are appropriate benchmarks? Well, over time, so certainly Walmart want to compare its performance in 28 to 2027. We're going to want to look at the closest competitor. Walmart probably considers its closest competitor right now to be Amazon. So compare its performance. How about compared to the industry, compared to the stock market? So how well did Walmart stock do compared to the S&P 500? The overall economy, as well as a comparison to budget. So did we at least hit our budget of what we expected? And so we can see these comparisons over time. So here's Walmart's common stock over a period of time and how well it compared to the S&P 500 and a couple of different S&P 500. And here's graphical form, here's tabular form of that. So looking there. All right, now we're going to perform additional analysis. And so we're continuing to look at these and seeing, okay, where are we at? Have we mastered the past? Now can we move to predict the future? But some techniques for financial performance include dollar and percentage changes, trend percentage, component percentages, and then ratios would all be included. And so you can see here we're doing a dollar on dollar, comparison. How much did sales increase? How much did net income increase or decrease? And we can do both dollar amounts. So it looks like 26, 27, 28. And so what's the increase or decrease? And what is it as a percentage? Comparing 2028 to 7 and 27 to 26. And so you can see there's a lot of ways to kind of divvy this up. And so taking a look. So evaluating percentage changes on our common size financial statements. Looking at trends. Okay. So what's the trends? So we establish a base year, then we go from the base year and go forward. So looking here, we're looking at these trends and trying to see this as a percent. So if we started 2023 as the base year, seeing what the increase in sales are and seeing what the relative increase in net income is or decrease, as the case may be. So here's an example of trends. We can certainly use ratios. And throughout this text thus far, we've shown ratios, showing the relationship of one item to another. For example, return on assets would just be net income divided by total assets. How are those related to each other? Is management effectively managing the business to be able to do that? All right, whenever we're evaluating financial ratios, we want to think about the characteristics of the company, the industry where they operate, the type of business they are. They're going to have a different profile, the size of the business, trends, and industry-wide averages. And certainly when we look at ratios, we want to look at liquidity, solvency, and profitability. And that's usually how these ratios are broken down to answer these questions. So liquidity basically says, do we have enough cash? Are we collecting cash fast enough to be able to pay bills as they come due? And we have both the current ratio as well as a more restrictive acid test ratio that does not include inventories. So current asset does include inventories. This one does not, so more restrictive. But it says, will you have cash? How well are we managing our business? Are we giving too many credit sales, making too many credit sales with people that aren't able to pay or don't pay? How fast are we managing our inventory? That's kind of a supply chain type of question. How about for solvency? Are we going to have, what's our relative liabilities compared to our assets, our relative liabilities compared to our equity? Can we pay interest as it comes due? And thinking about that. All in thinking of this, we need to think about the operating cycle and think about, kind of what's the cash to cash cycle. So if we use cash to purchase inventory, then at some point we sell the inventory, then we collect the receivable. This is kind of a cash operating cycle or just an operating cycle of how long does that take. For some companies, some industries, such as building a ship or an airplane, these have really long operating cycles, but others might be much faster. And so you can see what that looks like. So when we look at current assets, we're looking at those expected to be converted into cash within a relatively short period of time. And so cash, marketable securities, receivables, inventory, and prepaids. Current liabilities are expected to use the enterprise's current assets within the current period or operating cycle. And so we have a set of examples, both notes payable that are due within a year, current portion of long-term debt, right? Accounts payable, unearned revenue, and then various accruals that are included there. And so when we compare one to the other, we are going to use something like a current ratio. Ideally above 1, ideally well above 1 when we take current assets and divide by current liabilities. We're going to be a little more restrictive when we look at the acid test ratio and see what this looks like. Note this does not have inventory included in it. So you can see a much more restrictive, and says even if we have really slow moving inventory or aren't selling very well, we should still have enough cash to pay liabilities as it comes due. So working capital would be the difference between current assets and current liabilities. Total liabilities to equity would be just giving us an idea of the capital structure we have. So this looks like we have quite a bit more equity than liabilities. And so that's probably a good sign that says, we don't have too much debt as compared to equity. So when hard times happen, we'll likely still be able to pay our bills as they come due and not have to go into bankruptcy. So classifications in the income statement, we take it a little bit further. There's a multiple step and a single step. The multiple step essentially takes one step to look at gross profit and then takes operating expenses after that. And so if you were to look at the income statement here, you're going to see here's the first step between net sales and gross profit. And then here's the second step all the way down to net income, where it reflects the expenses included in there. Okay, operating income. Well, operating income is like an operating activities. On a cash flow statement, essentially we're looking at, are we creating money from our core business, whatever we do? I mean, businesses are known for certain things they do, and that is their operation. And we want to know, are we profitable or not? And so we're going to look carefully at operating income as well as net income. And that would arguably be the most important figure. That or earnings per share would often be among the most important. Okay, and so we're going to look at and determine net income as a percent of net sales to figure out, how profitable we are. The single step income statement follows that form. It's just all revenues, all expenses shown in that order. And some prefer it that way. Some do not prefer it that way. They like the detail. Most companies, at least most publicly traded companies, use a multiple step income statement, particularly if they have a cost of goods sold, if they show that. Okay. Earnings per share is arguably as important as net income, but it's just expressed on a per share basis. Now, we've covered this in other chapters, but we're simply taking the net income dividing by the number of shares outstanding to get the number of shares. So profitability, here's the listing of profitability ratios, the gross profit ratio, and we're something we'd like to track over time. So how much are we making over the cost of goods sold? Are we at least profitable at that rate, right? Return on investment, or return can be measured various ways, but typically net income, but also carefully defining what investment we're measuring. Is it equity? Is it assets? Is it some other measure to figure out how efficiently we have employed the company's resources? And a specific application would be return on asset, looking at operating income. Sometimes you're going to see operating income sometimes you're going to see net income here. And so you'll, just be cognizant of that, of what exactly you're measuring, but different examples. So even this one says, hey, we have made a profit of 72,000. And again, note here, we're using net income of 72,000 divided by the average total assets. And we compute that to be 570 plus 630 divided by 2, so 600,000 or 12%. Okay, we're going to take that same net income, and often that's going to be net income applicable to common shareholders. And so you may need to reduce preferred dividends or some other measure to get just that applies to common equity. And so here's the example of that. Here's the same 72,000, but now the average equity is 400,000, so 18% return. All right, so now we want to predict the future, and we see we want to think about a time series analysis as well as persistence. We note that sales is most persistent, and when I think about persistence, I think, what is the correlation between sales this period and sales next period? Or operating income this period and operating income next period. So we note here that operating income is more persistent than any of the cash flow measures. And that's one of the reasons we've done accruals. But this persistence is particularly important if we want to do something like this, which is take some measure of past performance. So here's quarterly income over time for IBM. And then we're going to use that to predict future performance to see if that's going to continue. You can see in terms of statistics, the dark red is the expected, and the top line is the upper confidence bound, plus or minus 2 standard deviations. So this would be plus 2 standard deviations of performance. And this would be minus 2 standard deviations of performance, because we expect some persistence. But this expected level will virtually never be right. It's going to be somewhere within this area. But we rely on persistence to help us use a time series analysis. So we're now going to evaluate the options, and that's our prescriptive analytics. And so we're going to use some sensitivity analysis or even some cash flow analysis. For example, here's Husqvarna on their 2023 report and says, hey, if the currency changes by plus or minus 10%, here is the impact on our company. Okay, and so look at this is Swedish crowns compared to the Chinese yuan. Here's the Swedish crown compared to the euro, and here's the market basket. Hey, what happens if raw materials goes up or goes down? What impact is that going to have on operating income? What if interest rates go up or go down? This is the impact. And these are examples of using different assumptions to see, if our predictions of the future are going to occur or not. And if all of these change by a drastic percentage, but we still say good investment, then that makes sense to go ahead and invest. But we have to kind of see where our vulnerabilities are included in there. So next, we're at the portion where we want to share the story. And so here we're going to share the story. The question is, do we want to do that in a graph or a table? Are we going to use a pie chart? Do you want to use a line chart or bar graph? What exactly we want to use? But here, J.B. Hunt is being compared to the NASDAQ Transportation Index, a peer group of similar companies, similar transportation companies, or even the S&P 500. And you can see the various returns. And at least on this graph, it appears that J.B. Hunt did the best. Now, maybe they haven't since the date of this, but this kind of shows relative performance over time.